everybody, it's John King, and I appreciate you joining me today for my live weekly Financial Fridays update. I'm super excited to continue to bring these to you every single week, giving you the information that you need to help make good decisions with your finances. A lot of the things that we talk about are going to be mortgage related, but a lot of them have nothing to do with mortgages. And as I mentioned before, and I mention every time, the challenge is we just plain as a society don't talk enough about finances, and we don't talk enough about money. And in some ways, I think we talk too much about taxes. The bad news is that's what I'm going to be talking about today. So I have a great topic today, and we're going to be talking with an amazing professional. I'll introduce him in a second. But our topic really is going to be big picture, how to save on your taxes. Now, the truth is the best way to save money on your taxes is, well, don't file them. But that's somewhat illegal. So you probably don't want to use that game plan. Since you have to file your taxes and you have to split money with your silent partner, Uncle Sam, I wanted to bring on my personal CPA, who is going to be able to really give good advice and good guidance and answer your questions. So I would like to welcome Gordon Lindstrom to the live stream. Good afternoon, Gordon.
Hi, thanks for inviting me today.
Absolutely my pleasure, Gordon. So I want to start with, who is Gordon Lindstrom? So if you wouldn't mind giving us the 3-word version, I'm kidding, you can stretch it a little further, on your journey, kind of what got you into this industry, and kind of what you do experience-wise and what you specialize in.
Well, okay, I'm the founder of a CPA firm in Stockton, and we provide services ranging from bookkeeping to payroll services to taxes. And one of the things that I do is tax planning. So we want to help people not only prepare your taxes, but we're looking for ways in advance to help you save taxes. Sometimes when you come see me in March, April, there's nothing I can do. Mm-hmm. But if we can get together earlier and we can do some planning, sometimes we can make some strategic plans and help lower the tax burden you might have.
So what you're telling me is that broadcasting this on January 27th is too late to save on your 2022 taxes in most cases, but that it's the perfect time to start thinking about how to save for 2023's taxes.
That's exactly right. Now's the time you could start putting some ideas in place for 2023. 22 is pretty much shot.
Yeah, it is. It is. Good riddance, 22. Being in the mortgage industry, real estate was challenged last year. Mortgages were challenged last year. So personally, I'm happy to say good riddance to 2022. So Gordon, it brings up a good point though, because a lot of people, and by the way, Gordon, I'm confident is very much like me, where I don't talk bad about my competition, and I'm not encouraging you to do so, Gordon. But what I do want to do is to point out the difference between going to a do-it-yourself tax preparation system versus going to a CPA, going to someone who can give you, personalized attention. Why would I spend more money to see you? I'm assuming I'd spend more money. Actually, I should probably double check to see if I can get cheaper taxes somewhere else. I'm kidding. But help me understand that. Of why, maybe a better question is, are you right for everybody, or should some people go to these online systems to get their taxes done? And how do we decide?
Well, the real problem with using some of the online services that are out there is the fact that there's no one that says to you, hey, this deduction doesn't really look like a good idea. Should we, if I take this deduction, should we just write a note across the top, say, please have an IRS auditor call me because I'm ready to talk to them right now?
Tattooed on your forehead?
Yeah, and that's kind of the problem, I would say, with an online service. It's going to let you do pretty much whatever you want to do. I represented a client in an audit who ended up taking his home mortgage interest in 4 different places on the tax return, because every time he put the mortgage interest in, his tax bill changed. And the online service didn't say anything; it just let him file his tax return. So I would say that's the primary difference, is by going to a professional, you have someone that's going to look at you and say, that's not a really good deduction for what you're trying to achieve. And sometimes it's like, let's say you're trying to buy a house, and maybe we don't want to take all your expenses so you can have a little bit higher income to qualify for a mortgage. It's possible to file a tax return and almost take your income down to zero. But then you go see John and he's going to say not enough income. You don't qualify for anything.
Right.
That's the primary reason you would want to use a professional to. They understand the situation you're in, and they're going to work with you to try to minimize taxes.
I love it. By the way, we've got probably 5 or 6 people watching live right now. If you have questions, feel free to post them. If I feel they're worthy, I'll bring them up and ask Gordon. But anybody that has any questions about anything, you can post it into chat on whatever platform you're watching it. YouTube comments, I'll be able to see immediately. Facebook comments, I'll be able to see immediately, and I can bring them up on the screen to address with Gordon. So at any point, if you have questions, feel free to bring those up. Now, Gordon, your answer, by the way, Gordon and I didn't rehearse any of this. And so, this is the bad news is he didn't pick up what I was laying down. The great news is he gave a different answer I wasn't expecting, which is how using a professional versus an online service will help you catch problems that could have made you a high target for an audit. Gordon, the direction I was going, which by the way, all of that is valid and maybe even more valid than what I was thinking. But the truth is these online systems or going to even if you go meet with a person, if you meet with a person simply to do your taxes, you miss out on planning for the year that you're in, that you're going to do taxes on next year. Talk to me about what that looks like and how you help clients through that planning process when you meet with them.
Usually as part of an exit concept, basically when we get done preparing a tax return, we want to take a look and say, okay, how have the rules changed for 2023 as you get done wrapping up your 2022? Is there anything differently you could have done or you need to do in 2023 that you didn't do in 2022, or the rules change in such a way that certain deductions you're taking in 22 you can't take going forward? And so that's one of the things we like to talk to people about is, here's where you're at. Here's what you may want to think about doing for this next year. For instance, if you're in field doing a lot of travel, maybe you need to get yourself an app that can track your mileage, so that in case anyone ever questions you, you've got all the mileage already on an app versus coming in and seeing me and scratching your head and trying to figure out what kind of mileage you got last year.
What did I put down, Gordon? 5,000 miles divided by how many work days are there a year? That's probably not the right approach to take when you have an audit coming your way. And that's kind of my point. When you look, there's no wrong way to do your taxes. And I actually want to address this, and I don't know what Gordon's answer is going to be. But Gordon, is there somebody that shouldn't come to you? Is there a circumstance where you're, forgive the way I say it, but overqualified, and they're better off going to an online service? Well,
generally not.
Okay.
Usually we can at least come up with some suggestions. If you're saying, the only thing I got is a W-2 and I don't want to use prepare, that may be fine. But by coming in and working with myself or someone in my office, maybe we can go through it and say, okay, maybe we can schedule it so either you get a larger refund or you don't get any refund, or you just plain break even. And that's the one of the things we can help you with. Do you want to give an interest-free loan to the government for a year, or do you want to kind of schedule things out so everybody breaks even, or even heaven help us, some people want to write a small check to the government at the end of the year.
Yeah. So Gordon, talk about that for a minute. This was not part of our scripted stuff we were going to cover, but everybody is confused about, everybody I talk to is confused about adjusting their withholdings. Obviously, it's a case-by-case circumstance, but can you give a high level of how somebody does that and how it impacts them short and long term?
They've come out with a brand new form for affecting W-2s, and it's kind of a complicated form to go through. So usually what you end up doing is doing a best case scenario, turn it into your payroll department and see what happens. And then, because usually we're shooting for a number, we're saying, hey, we want you to withhold $175 a week on your payroll. And so we do what we think is the correct calculation. You get your first payroll, and instead of $175, they're withholding $225, or they're withholding $100. Then you have a better idea how to go back in and affect, because everybody's payroll system is slightly different. So when I may calculate at 175, your payroll system may say, oh, no. That's only $100. So by using that, you'd be off $75 a week times 52 when you got to the end of the year.
Yep.
Which would wouldn't make anybody a happy camper. So,
Right.
It's sometimes it's a process that may take 1 or 2 weeks, 1 or 2 payroll cycles to get it ironed out exactly what it is. Because the days of going in and saying, oh, put down married to or put down single 0 are gone. You just can't get there on the new W-4 forms.
Well, that is news to me, because I literally expected that my next question was going to be, if I'm married, do I have to say married? Or if I have 2 kids, do I have to claim 2? You're telling me that doesn't exist anymore, Gordon?
It doesn't really exist.
Okay.
The whole thing is basically what the IRS wants you to do is break even. And that's the forms they give you right now are going to kind of break you even.
Okay.
Assuming nothing changes.
I'd imagine the IRS wants to get an interest-free loan from you, and that's probably ultimately a good thing for them, right?
Life is good.
For some people, and I don't know that you want to comment on this, Gordon, or not, but for some people, I feel like that interest-free loan is their best savings plan. Like sometimes people have you run into that? Have you run into people where, hey, you help them narrow down their taxes and they end up almost upset at the end of the year because, wait a second, I don't have a big refund and I count on that. Again, I'm not sure if you have any thoughts there.
I do have some thoughts. Because usually, if I do that adjustment, I'm going to tell people here, we're going to try and break you even or get you a small refund. But I understand the concept because a lot of people, let's say you have a large property tax bill coming up in April that you can't really save for. But by having extra money taken out of your payroll check, it gives you the funds after when your refund comes in to pay your payroll, so your property taxes. So I understand the concept. And I don't think there's to my way of looking at it, there's no right or wrong answer. It's what do you want to do?
Yeah.
So if you said, I really want to have a $10,000 refund at the end of the year, no problem. We can make it happen.
Got it. Well, let's move on to some pre-planned topics. So one of my first questions to you, Gordon, is what changed this year? What are some important things that have changed? And this year, I think, is a bit misleading because we've got what changed for 2022 that's going to impact your filing you're about to do. But then there are also theoretical changes that are enacted in 23 for the filing we're doing in a year. Is that correct?
That's correct. So right now, I'm probably going to talk a little bit about what's really affecting 2022. Okay. I think, especially in the mortgage industry, a couple of things that have happened is I, as a taxpayer, can no longer deduct the mortgage insurance premiums that are put in place, when you only put down, 5% down on a mortgage. So that deduction, which has been around for a number of years, is now gone.
Was that temporary? I feel like that was temporary and it ended, or was that taken away, or do you know?
No, it's taken away. It's been around for at least 5 or 10 years.
Okay.
And my understanding, it's taken away for now going forward.
Got it. So it's been around since you were in your 20s.
Yeah.
Just kidding.
The other thing that's, it's not a real change, but I think it catches a lot of people by surprise. So if you have a larger mortgage on your house, under current law, you can only deduct interest on the first $750,000 on your house. And that would also include your vacation property or anything else you have that's not a rental property. So what happens is you have a $800,000 mortgage on your house, your mortgage interest deduction gets trimmed by a hair. So those are 2 things I think that are affecting you in the real estate industry.
Strategically, though, that plays into buying rental properties then.
Yeah,
does that rule impact rentals? Say that again, I cut you off.
The rental properties, they don't have that rule. Rental properties, you can deduct whatever the interest is. A couple of other things that have changed specifically for 2022, obviously, is standard deduction has gone up a little bit. And the nice thing, the tax brackets have gone down a little bit. So if everything stayed exactly the same from year to year, your tax burden would probably drop a hair based on that. But at the same time, the credits for children have reverted back to where they were a couple of years ago. Earned income credits are down. I think those are what I'm seeing as probably the major changes right now.
So Gordon, please correct me if I'm wrong, because that's why I have you as an expert on here. And maybe what I'm asking isn't truly fact as much as it's theory. But I feel like, look, the government needs the money the government needs to operate. And you can't decrease taxes without increasing somewhere else, or we're going to increase the deficit, which obviously is a whole nother discussion we're not going to get into. But is it fair to say that in most years when you have an adjustment to taxes and you win in one place, you may win and have no losses, but somebody else is likely to lose somewhere else, and they're basically just trying to incentivize different actions, different circumstances, but it sometimes is a net zero gain. At the end, they're going to get their money. They're just getting it from a different person under different circumstances. Do you agree or disagree?
We're seeing, especially in the solar industry, the EV car industry right now. So obviously the government has certain programs out there that they want to push and promote. And so they're going to give credits and whatnot there, but they're also going to take a deduction away from somebody else someplace else.
Yeah.
So in the long run, everything has to balance out to make the government go forward.
Got it. So speaking of something that's got to balance out, I get money transferred from my friends and my family to pay me back for dinner the other night and pizza, and now I heard I'm gonna have to pay taxes on my Venmo. Help me understand that. Is that really the case?
Okay, well, that there was a new rule that was put in place for 2022 that was temporarily suspended regarding reporting requirements by Venmo account, the PayPal accounts, the Cash App accounts, where they're required to send businesses the amount of Venmo, PayPal funds that they've collected. The real problem that they came up with, I believe, is the fact that they couldn't separate between a business and a personal Venmo account. So they got a lot of blowback, and so they've suspended this rule for about a year, and they're going to come back. The tax rule is going to be back in place this year. So if you're using Venmo or PayPal to run your business, you should be picking up that money that goes through those two accounts as income.
Right.
You're not going to get a statement this year in 2022, but there will be some reporting requirements in 2023 when you get ready to do the next tax returns. So
again, this is back to what we said earlier about advanced planning. There's tax avoidance. Is that the bad word? Tax
avoidance is okay. It's tax evasion that has a problem.
There you go. Help me define the difference.
Well, tax evasion, I think, is literally going out and trying to find a way to cheat and manipulate so you don't really pay your taxes.
Okay.
Tax avoidance would be an example would be maybe putting your child on payroll to avoid paying some taxes on certain other types of income.
Got it. So I'm going to say something taboo, and you can pretend I didn't say it. I hear from people saying, "Well, gosh, that just means I don't want to get paid through my Cash App anymore because it's going to get tracked." Well, the IRS is pretty clear. I don't care if they paid you in cash or in coin or in Bitcoin or in anything, like that's income earned. So making a change like that would be considered tax evasion.
Yes.
And that's where you got to be careful.
That's correct. I mean, if you're saying, "Hey, I've been getting money from PayPal through my business, and because I'm not getting a form, it's not being reported to the government, I'm not going to put it on my tax return." The same thing, I've been collecting through Venmo on my business, but I don't get any report from Venmo showing how much I took in. I'm not going to put that on my tax return. That technically would qualify as tax evasion.
Got it. Okay. And that's what gets us in trouble. Here goes my videos kind of goofing with me and getting me in trouble, but that's what gets us in trouble. So we want to make sure we avoid that. But let's talk about some tax savings ideas across the board. I've kind of categorized this into some tax savings ideas for W-2 employees and then some tax savings ideas for self-employed. Before we go into those specific categories, Gordon, do you have any comments just on the general concept of how do I pay less in taxes?
But that's a great question, and everybody has that question. So it's a lot of it is sitting down and taking a look, and are you overlooked deductions on your tax return. For instance, let's use charitable contributions as an example. We all know you go give money to the Boys and Girls, you give money to the church, you give money to the temple, and we can deduct that. But what about all the stuff we give to Goodwill, all the stuff we give to Salvation Army? People are stuck on the thought of, hey, I can only deduct $500 of Goodwill or Salvation Army, and that's not correct. The real number is, what is the value of that property you've given to Goodwill? What is Goodwill going to sell it for? That's your charitable contribution, not $500. And it doesn't take a whole lot more paperwork to be filled out for you to take that deduction. So people with young kids, people that have children between the ages of, let's say 3 months and 12 years old, they're going through clothes all the time, and you're turning around, for the most part, you're deducting that. So you need to keep track of it. I tell people, take a picture of it. In the long run, a picture's worth 1,000 words. It's going to show that you also gave this kind of stuff. Get a receipt from Goodwill and fill it out. Goodwill's not going to fill it out for you. It's up to you to fill it out. So put something down, and then take a look at exactly what you've done. So that's one way that you can legitimately start bringing down your taxable income without really making a big change in your life. Something else, a lot of times I see people that are involved in church, and you're providing services to the church, whether it's mileage or food or something like that, and you're not deducting it. So we're not trying to change anything you're doing. All we're going to do is try and get some of the stuff you're doing and shift it around to someplace that's deductible.
Let's dive deeper into that really quick. Is it literally church? Is it any nonprofit? I want to volunteer with the SPCA. What can I deduct? Can I deduct my time? What is it if I'm under what?
Time is never a deduction, but you can, a lot of people that volunteer at the SPCA, for an example, they're taking dog food, they're taking cat food to these places. All that's a deduction. So, let's, get a receipt. Let's track that kind of stuff. Some of the mileage you may do may be deductible. It just depends on certain circumstances. People that are involved in animal rescue, their mileage to go pick up animals and bring them from one place to another is deductible. So once again, it depends on what you're in, but and looking at these various charities, it's just a matter of taking a look and saying, what do you do, and is it something that we can track and something that we can deduct? But just because you've gone and you went to work on the church building project today doesn't make your time deductible.
Darn it. But the mileage that I spent driving to the Home Depot to buy the paint that I bought to paint the church, all of that theoretically could be a tax write-off.
That's correct.
But only if I'm itemizing.
That's correct too.
Can you explain in layman's terms? By the way, we've got about a dozen people watching right now. Anybody who's watching live, if you have questions for Gordon, please post them into comments whatever platform you're on, and we'll pull them up when appropriate. If you have any ahas or amens for great ideas, I'd love to hear that too. So Gordon, what are your thoughts?
I'll say that one more time. I got lost in your.
Do you know what's funny? I got lost too, and I was hoping you were going to remember, which is why I simply said, "What are your thoughts?"
Okay, I think one of the things that everybody has to look at is: are you better off itemizing, or are you better off taking standard deduction?
That was it.
You have to remember, for a single person, the standard deduction now is about $13,000, $12,950. For married filing joint, your standard deduction is $25,900. So that's going to include things like your mortgage interest, your charitable contributions. Unfortunately, the way the current tax structure is set up, you can only deduct the first $10,000 of your property taxes and your state income taxes. That's right? That's where we see a lot of people having a cut. So even if you said, hey, my property taxes are about $9,000 and my state withholding was about $4,000, so that we're working at $13,000, you can only deduct 10. And it doesn't matter. If you structure, there's ways. Even if you start shifting those numbers around, the tax system is still going to limit you to $10,000.
Got it. Got it.
So, so it's a matter of planning. So taking a look is, okay, so if I have a low interest mortgage and my interest is $5,000 a year as a married person, and my state is $10,000, I'm at $15,000. Before I can itemize, I really have to kick up about $15,000 through charity or through medical expenses. And medical expenses are probably a place you really don't want to generate deductions at. But in order to become deducted as a medical expense, it has to exceed about 10% of your income.
Got it. So that brings up a really good point, Gordon, because if I need to get a bigger deduction in order to have an itemized deduction, a great idea is to refinance your mortgage today to get rid of your 2.5% rate and pay 5.5% because you get a bigger write-off. So isn't that a good reason for everybody to call me and refinance because now they get a bigger write-off?
Well, that's true.
For me, it's true. But I actually want to take that one step further, which is the concept of, hey, well, if I spend more money in interest, no big deal because I get to write it off. Is that really the case? Like, do I get does it save me dollar for dollar? Is it no big deal? Or
I think that's not, you have to remember that it's your deduction is only as good as, so let's say you ended up with, when dust settled, you had $40,000 of deductions. Those extra $10,000 are only going to be deducted at your tax rate, anywhere from 15 to 22%. So you said, hey, have an extra $10,000 in itemized deductions. Okay, I can save you $1,500 in taxes at one rate, or if you're at a higher tax rate, you may save $2,600 in taxes, but it's not going to be a one-for-one write-off.
You spent 10 grand to save 1,500 to 2,600. So my father was a enrolled agent, a tax preparer, and I remember growing up, he's like, oh my gosh, I had a kid so I can get another tax write-off. And he said, your kid costs you way more per year than your tax write-off. So do not have it. Now, if you have a choice of having your kid at 11:59 p.m. on December 31st or 12:01 a.m. on January 1st, have your kid you never want the first kid of the new year because you lose the tax write-off from last year, right, Gordon?
That's right. You always want the child as close to the end of the year as possible.
Yep, they cost you nothing and you get the full year's write-off. So if you want to be that parent that has the first kid of the new year, you've just had horrible tax advice and you want to make sure you get that kid out before midnight.
That's right.
All right. See, we're giving parenting advice and childbirth advice. You guys are getting everything here.
Everything in
Aren't
one
you
shot.
Okay. Again, if you have any questions, please feel free to post it into chat and Gordon and I can address it. So Gordon, let's talk about some tax savings ideas for wage earners, for W-2 employees. And we've got a PowerPoint slide with some ideas and we'll kind of pull that up and share, but let's start at the top. Anna, if you could pull up that slide for us. So talk through these a little bit for us, Gordon.
Obviously, a 401k is probably the best deduction for a wage earner, because basically, once again, it's not a tax credit, but let's say you can put into your 401k, you can put like $60,000. But let's say you put in $10,000, it's going to reduce your income down, and then depending on what your bracket is, you could end up with $10,000. You're reducing your income down. You could end up with a tax savings of somewhere between $1,500 and $2,600. And if you're someone who's in a slightly lower tax bracket, the IRS actually gives you a credit of about 10% for the money you put into that retirement vehicle.
I love it. And I think the thing that people also miss is a lot of employers give you matching money.
Yes.
Maybe up to a certain, go ahead.
As I tell people, if you have a 401k and your employer is contributing, let's say they match you 5%, if you're not at least putting 5% into your 401k, you're losing, that's 100% rate of return. You're losing money right off the bat. So you need to, as a W-2 employee, you need to be putting in enough to get your full match from your employer.
I agree. I teach kind of a 4-step plan of money, growing money. And in my opinion, the first step really is owning your primary home because of leverage, because you get a tax write-off, and the appreciation is based not on what you put as a down payment, but it's based on what you put, what your home purchase price was. The second step being that you are going to be able to make sure that you build a reserve account. Make sure that you've got at least 6 months of reserves in your savings account. And then once you do that, your third step is max out your 401k. And I think that's kind of what Gordon is saying here. And again, Gordon, correct me if I'm wrong, but having a 401k and maxing it out, what I look at is to say, hey, you're going to get 100% return on your investment, but you're investing $10,000 a year. So you may only gain 10 grand. Right. You're actually better off in some cases reducing your 401k contribution if that's what it takes to afford to buy a home and to be a homeowner, because you're getting a big tax write-off and you're getting appreciation based on the actual purchase price of your home. What are your thoughts about that?
I like that idea. It kind of, once again, it's advanced planning. So it's just a matter of sitting down and figure out, how much, if I'm putting money into my 401k, it's obviously money that's really difficult for me to get out to buy a house. So if I want to buy a house and I say, hey, I'm going to buy a house within 2 years and I need X amount of dollars to buy that house, maybe, reduce the amount you're putting into the 401k so that you can actually fund a fund that you use for the down payment on the house.
Yeah, I think that's half of it. The other half of it is, hey, buy the house sooner, have a little bit higher payment because interest rates are up right now. But conversely, you get now your tax savings starting now, and decrease your 401k for the first couple of years until you can refinance to lower that interest rate and payment, or your income grows enough that you're able to now continue your contributions again. So two different ways of looking at it, both the same thing, which is just because it's good advice doesn't mean it's the right advice for you. Would you agree with that, Gordon?
That's right. So it's a matter of just sitting down with someone and just, I'm going to call it crunching numbers. Just take a look at this and see what makes the most sense.
Yeah. As you sit down with someone, I know, Gordon, you call me a fair amount of times with a client in front of you saying, hey, I got a question about whatever. And John, you're my expert. What other type of experts do you collaborate with a lot? What industries do you feel go hand in hand with tax planning?
Well, obviously I try to work a lot with financial planners also, because they can if they can steer a client there and they can give the client some advice on how to invest money. Maybe people come in. I don't want to tell someone that you need to put money in the stock market. Maybe you don't want to be in the stock market. Maybe you should be in bonds. Maybe you should just be in a CD. You can get better advice from someone like that, and I think that's a key that a lot of people need to be dealing with. And some of the other, I also deal a lot with attorneys in the area of estate planning. You own a house, you own a rental, and you have 3 kids. Have you thought about how your estate's going to be handled if you pass away? And that's why we have attorneys to help you. I can tell you what I think the answers are, but you really need to sit down with a professional in that area to make sure everything's done exactly right. So we tend to work a lot with attorneys and a lot with financial planners also.
That the estate planning thing, this wasn't something we had outlined to talk about, but I think it's a big one. Can you speak to, so I kind of I changed our header back to general tax savings ideas, because this isn't just for self-employed or W-2 people, but as a general statement, what are the things we need to be worried about when it comes to taxation when my parents pass away or something happens to me? And what are some missteps people might take that can really hurt them in that regard?
Well, the bad thing is it's not going to hurt you. It's going to hurt your kids. It's going to hurt someone else. So, big misstep. Had a client passed away before he got his estate planning done, left $500,000 to his 18-year-old son. And no matter, we tried all kinds of things to kind of keep the son's money in a trust, but he ultimately got the money, and all that $500,000 was gone in about a year and a half. Yep. So I think that's the major thing is how do you protect your heirs going forward? Let's say you have a disabled child. What do you do to make sure your disabled child has enough money to live on if you're gone? So there are, I think And hopefully, most preparers you go to are going to ask you some of these questions. I'm preparing your tax return and I see that you have a disabled son. Have you put together a special needs trust, or have you taken care of anything to help take care of your disabled son going forward? If the answer is no, then I'm going to refer you to an attorney that you need to get in touch with. Because, life is quick and life is fast and it's very uncertain. And you don't have anything taken care of, and all kinds of bad things can happen.
I agree. So I have a specific scenario that I come across a lot, and that is, hey, I want to add my kids to the ownership of my home so it makes it easier when I die. So I'm going to put their name on the ownership of my house.
And that's a cool idea. The only problem is, your kids run over a van load of school kids, and all of a sudden your house is eligible to take care of their lawsuit issues.
Did we really need to go there, Gordon? School kids?
Yeah.
Come on. This is like live stream here.
But your house now becomes is going to be subject to any lawsuits or judgments filed against your kids.
What about the basis? How does that get impacted if I add my kids? If my mom adds me to her house, what is basis, and what is the whole thing I hear about step up in basis? And does that
basis is really easy. Basis is what did you pay for the house. Well, that'll be the easiest way to put it. So if I gift, let's say I've lived in my house for 20 years and my house has gone up in value from $100,000 to $600,000, and I gift part of my house to my kids get that part of the house at my basis. So if I give them half the house, their cost basis in the house is $50,000. And then if the house is sold, they pay capital gains on that difference. Whereas if I hold the property until I die, my house then gets raised to fair market value, which is called step up in basis. And then the house can be sold with no gain or loss.
So I'm gonna put the final touch on that with math. I know math is really hard for both of us because we never ever do that in our career. So your scenario, you bought your house for $100,000 and you adopted me as your son, and you want to give that to me personally, Gordon. I'm planting subliminal messages here. And so you say, hey, John, I'm going to add you to the ownership of my property right now. Well, then I own half of it. Which goes into, hey, is it tenants in common or to own half or a certain percentage? That's a whole nother conversation. But let's just pretend I own half. And then we decide, even at that point, whether we decide to sell or worse yet, you pass away. Well, now I get your half inherited to me. So my basis now on that half goes back up to half of the current value of 300. But the half that you gifted me while you were alive, my basis on that was only 50 grand. So I'm going to sell the house immediately after you pass away because, Gordon, I don't like your house. I really don't want it. I just wanted the money. That's the only reason I'm convincing you to adopt me is for the money. So I'm going to sell the house right away, but I'm paying capital gains on $250,000 versus had I waited to get my ownership of the home until you passed away, I'd pay zero capital gains. Is that correct?
That's right. Yes.
Okay. So huge misstep people make. I'm not saying that you shouldn't ever add your kids to title. There's other times when it's a smart idea or a necessary step for qualification that I might say, hey, you're going to have a negative tax impact for this in the long term, but in the short term, that's the only way you guys are going to be able to keep the house or be able to get the cash that you need.
And sometimes there are legal aspects to gifting. There may be a legal reason why you may want to transfer a house from parent to child prior to death. And that area usually comes in Medicare, Medi-Cal planning. That's a whole different problem.
So let's get back to the ideas for saving money on W-2 employees. What's an FSA?
It's like a medical savings account.
Okay.
Basically, it allows you to save money for medical expenses or to pay medical expenses. And it's a deduction on your federal return, but not a deduction on your state return.
Got it. Okay. So Penny has a question. We're going to go backwards for a quick second. Penny, thank you so much for bringing up the question. Penny said, wow, now it's got Penny's picture. That's new. So this whole system's been upgraded. Woohoo, Penny, you got your picture on there. What about transfer on death deed? So I'm going to extend the question and say, obviously, we were just talking about the step up in basis and how that works. So is a transfer on death deed a good or a bad idea insofar as how it impacts the step up in basis?
Well, Penny, basically what it is, just another estate planning tool. So basically what someone has done is said, hey, when I die, you get my house. And so the deed's already drawn up, or the paperwork's already drawn up. So that basically is just going to be another form of transfer. Generally, that transfer avoids probate and other things. So you would get that happened, you would end up with a step up in basis. So you could get a transfer death deed today, and the property keeps on going up, another $400,000 or $500,000. You're still going to get that step up in basis when you sell the property based on that transfer of death deed.
Got it.
All it does is just it's when the property transfers.
Perfect. Penny, if that didn't answer your question, feel free to put in another comment here. And Gordon, you made a really good point, because we now have on record from an expert that real estate always goes up.
Of course. Never know.
No, we're not saying that. Anyway, let's dive back into, so FSAs, you covered kind of what that is. What's a dependent care plan?
Dependent care plans, and people have to be careful of this, because a dependent care plan basically allows you to take money from your W-2 or from your wages and pay for your children's daycare. It's basically, in essence, what it is. But where I see problems arising at is basically that works out really good until your child hits about the age of 12. At age 12, you can't take dependent care expenses anymore for them. And some people are still taking that $7,000, $5,000 out of their W-2, and then what happens is that just gets lumped back into your wages on your tax return. So you end up not use that kind of program. You have to make sure that you terminate it at the effective time.
Got it. And both FSA and dependent care accounts are use it or lose it accounts. Can you explain that?
Yeah. Usually I don't see use it or lose it so much with a dependent care as I do with an FSA account. So you have to be kind of careful and plan how that is done. A lot of times I would almost rather see like a medical savings account, which the nice thing about a medical savings account is if I don't use it and I keep on contributing to it every year, when I retire, that becomes like another form of an IRA. So from an employee standpoint, I'd rather see an MSA and not an FSA.
Got it. Well, I say, okay. Hey. All right. Let's dive into tax savings for self-employed. So we've got about a dozen people on here right now. I know a lot of people that watch this are self-employed people. And I think this is a big one. I think this is a big category of, man, I have a silent partner in my business. By the way, and Gordon, I don't know if you're the one that told me this or somebody else, but they said there is no such thing as a sole proprietorship. You don't own any business by yourself. Every single business owner has a silent partner named Uncle Sam.
Yeah, that's right.
So give me the big picture before I dive into some of the specifics that we put on our PowerPoint. What thoughts do you have about self-employed people and how to save on taxes for them?
But usually, when we deal with self-employed person, one of the things that you're caught in as a self-employed person is you're paying Social Security taxes on all your income. Sometimes there's areas you can go, like you can go to a corporation or another vehicle if your income is high enough to avoid some of those self-employment taxes and take it out in the form of wages. But it's something you almost have to sit down and talk with an accountant and an attorney about, trying to figure out at what point in time does it make sense to say, hey, I'm not going to be self-employed anymore. I'm going to be a owner of a corporation, because you have to keep, there's some special rules when you have a corporation. They really want you to keep minutes. They want you to have annual meetings. Then, okay, not only do you have to deal with the IRS, the state of California has gotten involved. California has a minimum tax on corporations. Then you got me coming along saying, you got to prepare a corporate tax return. So you got to pay me to do that. So you got to look at where's the break even point at the shift away from a sole proprietorship to a corporation. Usually we find it kind of makes sense somewhere. If you said my income is $45,000 a year net, we probably would say stay where you're at. But if you said my income is $65,000 on up, we'd say, maybe it's time to start thinking about incorporating, because there's things inside the corporation we can do that could save you taxes.
Is when you say my income gross or net, and can you explain the difference?
Gross is what comes in the door, and net is what you have when all the expenses are paid.
Okay. So when you talked about the 45,000, 65,000 numbers, and you said, hey, if you've got income of 45,000, you should stay as, a sole proprietor theoretically. And guys, we're not giving tax advice. Let me be super clear. You need to talk to a professional about your situation. So do not take what I just said or how Gordon just said it as, okay, I'm going to do it because I got it from a professional. But Gordon, knowing that we're not giving advice over the internet.
Yes. Because the real problem is if you just jump ahead on what I'm or John are saying is there's all kinds of places you can go out and get a corporation set up, and you may not really fully comprehend what the deductions are or what the liabilities you're assuming are. So before you incorporate, before you form an LLC, before you do anything, you really need to sit down not only with a good CPA tax accountant, you also need to sit down and talk to a good attorney, business attorney too, so you have a better understanding of what's going on there. Because not everybody can be a corporation. Even if you said my income is $500,000 a year, you may be in an industry that California does not allow you to incorporate.
Well, so that brings up a question that I've heard a couple of people say is, California state taxes are really high. And I don't know, Gordon, name a state that has low or no state income taxes.
Oh, Nevada.
Nevada, perfect. So I'm going to incorporate in Nevada so that I don't have to pay state income taxes. Is that a true or false statement?
That's false, because you're still a resident of California. So the income coming in from Nevada is going to be taxed on the California side no matter what.
Got it. The governor's made sure that he's going to get his money no matter what.
Yep. So the only way to beat California is to actually leave California and live someplace else. And
got it. And
the franchise tax board has some really strict rules and regulations that they enforce.
So, all right, fair enough. Then I run a business. I own a tire installation shop here in the Sacramento area, and I decide, I'm moving to Nevada because I can pay no taxes in Nevada. But my business is still in California. I didn't shut down my business here. Am I paying Nevada taxes or California taxes?
You're paying California taxes because you still have the business on, and the same thing applies to rental properties. You could go wherever you want to. You have a rental property in California, you still pay California income taxes on your rental property. So basically, I think the term is nexus. Where's the property located? Where's the business located at? That's where you're going to pay taxes at.
Got it. But I can live in California and open a tire shop in Nevada and not pay taxes on it.
Yeah, or you could move. Let's say you move to Oregon. Now you pay taxes in 2 different states.
And I get to pay you an extra fee to file a vote.
Oregon tax bill.
Got it.
So
okay.
Again, before you start moving, just double check with people that understand how the tax law works.
I love it. Perfect. So let's dive into, Anna, can you pull up our PowerPoint on some of the things we want to talk about specifically? Business structure. We've touched. Tickling is probably not the right word here, Gordon. We've touched on business structure. Can you talk through these and explain what the difference is and maybe a little bit of why you would use one versus another?
Yeah, let's start with sole proprietorship. Easiest business to get into. You don't have to have any no legal forms, no nothing. It's just you can set up a business sole proprietor very easily. You go into things like let's see, how about a partnership? Partnerships usually a little more formal. Usually have a partnership agreement between, there may be a managing partner, there may be people that are partners that don't really have a say in how the business is structured. Basically in general, a partnership is, the income is split. Let's say you got 2 partners. Usually it's fairly easy. The income is split 50-50. Partnerships, The income is generally subject to Social Security taxes, just like a sole proprietorship is. An S corporation, let's start with the C corporation. C corporation is the corporation that everybody files automatically when you file and elect to be treated as a C corporation, which means you file paperwork in Sacramento to be recognized as a corporation. C corporations are taxed on their own income, and for a person who puts together a corporation, there's only a couple of ways for you to get money out of that corporation. That's through wages or interest or dividends. The problem with dividends is that dividends are non-deductible by the C corporation and taxable to you. What we see most of is S corporations, which stands for a small business corporation. Basically, that means essence, when the income and expenses is split. So it's, once again, let's say you got two owners and they're 50-50 owners. After all expenses are paid, the S corporation will issue you a form, which is called a K-1. It says your share of the income is this, and your other shareholders' share of the income is this. One of the drawbacks you have to remember with an S corporation is that IRS expects the shareholders that are actively involved in the management of the business to take out wages. So you just can't say, because all the income at the end that the K-1 distributes is not subject to Social Security taxes. And that was the original beauty to an S corp, is that you were able to eliminate completely your self-employment taxes. So the IRS finally figured that out and said, okay, now we want you to make sure that everybody who's an officer or director or works in the corporation receives a W-2 for a fair amount of earnings.
Got it.
So in a nutshell, that's it.
Yeah, no, that's beautiful. Remember, gang, if you have any questions, post them into the comments on whatever platform you're watching. Gordon, a lot of my audience is real estate agents. I talk to realtors all the time. I'm going to ask you to generalize. I see a lot of realtors are sole proprietors. What are some benefits to changing to an S corp for a real estate agent?
Well, if you're making enough, once again, if you're very successful, it makes sense, because now instead of saying, hey, I got $100,000 of income I'm paying self-employment taxes on, we could say, hey, we're going to take a salary of $48,000. We're going to pay Social Security taxes on $48,000. The other $52,000, it just comes out to you, and it's not going to be coming out to you subject to Social Security taxes. Just so basically, what you're doing right off the bat is eliminating a portion of your Social Security taxes by incorporating. Okay.
What's the negative? Why shouldn't I do it?
Well, the other problem with it, especially in California, is that real estate agents can't typically be treated as an S corporation. So real estate agents have to do kind of a double step and register as an LLC, and then do the paperwork to have their LLC be treated as a corporation.
And that's just more paperwork once? Does that create long-term implications by doing that double step?
No, I mean, it puts you into an S corporate status, but once again, that's really good if your income is up. But what happens when the years when your income, real estate fluctuates? So this year it drops to $20,000. That S corporation is not doing you any good. You're still paying the state of California. You're still paying me to prepare the tax returns. So there are some long-term implications of doing that.
Can I opt out for a year? Hey, it doesn't make sense this year. I want to file the other way.
No. Once you're in, you're in.
Okay. It's like Fight Club. We don't talk about it. Once you're in, you're in.
Yeah.
I got it. I love it. Okay. So a couple more things, gang. We've got about 5 minutes left. So we'll cover a couple more topics. If you have questions, post them now, so I make sure to cover them before we finish. Gordon, what's a SEP?
I'd like to skip down to number B, your SEP IRA contribution.
Yep.
SEP IRA contributions are work a lot like for an employer, work a lot like a 401k. If I have a SEP IRA, I have to cover all my eligible employees that pay into their SEP IRA, just like it would if I had a 401k. So generally, we encourage a lot my employers to look at a simple IRA. The simple IRA is going to allow you to put in like about $27,000 a year, but you only have to match your employees that care to participate. So if I have 10 employees and only 2 of them want to participate in the plan, I don't have to cover them. I can still fully contribute to my account, but I'm not having to, so I don't have to contribute to their accounts also. So usually we're seeing more and more people, for the simplicity's sake, going to a simple IRA as opposed to a SEP, because a lot of times you don't really want to be paying for all your employees.
So is this the first time in history that the IRS named something what it really is? Like a simple IRA is simple?
It is. The paperwork, I don't work in it, but the real estate, the investment advisors that I work with say, hey, it's just a 1-page piece of paper that needs to be filled out. So it's a fairly easy process to accomplish, especially now in California. Now that we have a new law that says if you have more than 5 employees, you have to set up a plan for your employees.
Got it. All right. So with the couple minutes we have left, let's talk about home office deduction and hiring your kids.
Okay, let's skip to hire your kids. I like hire your kids. Just from the standpoint of the nice thing is kids, let's say they're 8 years old and they're on payroll. As long as we have them doing something productive, we pay them, let's say we pay them $4,000 a year. That money, it goes to them on a W-2. You don't have, as long as you're a sole proprietorship, you don't have to withhold Social Security taxes. You don't have to withhold income taxes. They don't have to file tax return because they're underneath the $12,000 limit. And at the same time, you've deducted $4,000 off your tax return. So that's one of the beauties to hiring your kids. Sometimes the other thing, what we've done with certain kids is we've taken this $4,000 and we've rolled it into a Roth account for them. So now, over the next 10 years, they get to be 18 years old before the money really goes to them. They can, at that point in time, take the money out tax-free and with growth and use that to buy a house, use it to fund education. It's all going to come out to them tax-free.
I thought you had to be over 60 something, 58 and a half, the qualified age in order to pull money out of a Roth without taxes. So how is this?
No, Roth is, you have to leave it in for 5 years.
So I can put money in a Roth right now, 5 years from now, and pull it out, and I don't pay any taxes on the growth?
That's essentially yes.
Awesome. I was completely unaware of that. So I learned something today. I love it. Gordon, I don't know if you want to touch on home office deduction or if you want to kind of just cover it.
The real thing people have to remember with home offices is generally it has to be an area that's used exclusively for business. So you can't say, that 3rd bedroom in my house, I have a bed in it, a dresser, but really no one lives in there. And I also have a small desk in there. I'm going to write off I want to write off that whole office or that whole bedroom as my office. And, if push came to shove, the IRS came and looked at this, or, you had to provide them some sort of documentation, your deduction would basically be the square footage of your desk plus the filing cabinet and stuff like that. So just be really careful with that deduction, because that's a deduction. The IRS is starting to realize that it's been a little bit of abused. And, if you have a home office on your tax return and it looks like your home office is more than 6 to 8% of your total house, that's kind of like, where's my red crayon? I really want to be audited. Please call me as soon as you get this tax return. Got it. And once again, it's just, sitting down using a tax professional and making sure that you are eligible for it. Because, we've taken home office deduction for literally for a 30 square foot area. There's every, certain extent, it's going to pick up some extra deductions you don't get anyplace else, like your janitorial service, your cleaning lady, your security system, your utilities, all those things you really don't have a deduction for someplace else.
So I'm going to throw you a curveball at the end here, Gordon, since nobody's asked any questions. By the way, if you have a question, feel free to post it. What's the Augusta rule?
The what?
Augusta rule. Have you heard that?
No, I haven't heard of that one.
When
did this one come out?
So I don't know. And maybe it's just what somebody's calling it, but I've heard somebody talking about the Augusta rule as being a a way, like, because Augusta, I guess, is where a major PGA golf tournament happens every year, and people who live there can rent out their primary.
Yeah, I know what you're talking about now. Yeah, so basically you can rent your house out for essentially for 2 weeks out of the year and not pay any. It's a not reportable income.
So some people are
Basically,
using that to say,
they
hey, I
did justice, but it came back from the 1984 Olympics when people in Los Angeles were doing this. So
Got it.
yes, so say you collect $12,000 renting your house, it's technically non-taxable income.
almost Airbnb, like you rent your house out for 2 weeks because you got a major event nearby, and you can get that income and not have to worry about paying taxes on it.
That's correct.
Love it.
And it
Gordon,
doesn't
I really
affect
appreciate
your ability to deduct anything else on your house.
Perfect. Gordon, I really appreciate your time. Hopefully, gang, you found this to be valuable information. If you have questions, Gordon's contact information is on here. If you need great tax advice, please give him a call. I thoroughly recommend him. He and his team are amazing. As I wrap up, I just want to remind you, I am not a nonprofit organization that would help me a lot on my taxes, but I do this to earn your trust and goodwill so that when you come across people who need mortgages, need good advice, that you would refer them to me. So please don't forget about me and don't keep me a secret, and have a wonderful weekend, and go Niners.